Hey guys, welcome back to the channel. Today's a quick video on how to price options through R, and we're going to install RQuantLib and require some of these packages as well. And we're going to try and price in Apple's $400 call option that expires September 18th. Alright, so we're going to require some data. Here I'll set my ticker. Alright, and here I'm going to use getQuote to extract the dividend yield and the last price for Apple. So I'll write Yahoo QF C and then dividend yield. And also the last trade price only. To see what we can extract from Yahoo getQuote, we can just run Yahoo QF. And here's a list of items you can extract. But for this example, I just want the dividend yield and the last price. So here I'll just hit escape. So we'll store that in stock by running getQuote. Ticker, what, we'll pass in Q. So we'll run these lines. I also need a discount rate, so we'll use the US Treasury 10-year note yield. And to get that data, we'll just use get symbols and scroll down to where it says Fred. And then the ticker for that is DGS 10. The environment will be global environment. And these rates are annual rates, so I need to convert them to daily rates. So what I'll do is I'll store the daily rate, and I'll use NA LOCF DGS 10. So first I need to divide by 100, and then to get the daily rate I need to divide by 360. So we'll run these lines. I also need Apple's historical quote, so I'm going to request that from Yahoo by running get symbols, ticker, and then auto assign is false. Alright, so the expiration date, so I'll just write as date 2020 09/18. I'll save today's date here. Here I'll save the days to expiration. I'm going to save these as numeric, so it'll be expiration minus today. The type of option we're pricing in is a call option. Alright, so here I'll save the latest quote for Apple. Strike price is 400. Dividend yield is stock dividend yield. Here I need to calculate the time till expiration in years. So RQuantLib has a function called year fraction. So start date is going to be today. End date is going to be expiration. Day counters, we'll use 1. Here I'm going to save the risk-free rate. To calculate that, we'll take a look at the latest yield for Treasury. So if we were to buy a 10-year Treasury today, we would yield this much per day. So what I'll do is just sum the latest Treasury quote by the number of days left till expiration. So I'll use rep the latest Treasury yield by days to expiration. Alright, so next I'll calculate the volatility by running as numeric last volatility, open, high, low, close of our data. Here I'm going to use a look back to calculate volatility of 25 days. So we'll go ahead and run this block. Alright, so since this is an American option, we're going to use American option type. We'll set that equal to type. Underline will be underline. The strike will be the strike. Dividend yield will be div y. The risk-free rate will be RF. Maturity will be EXP for expiration, and volatility will be VOL. And then in order to get some Greeks, we'll use engine equal to crank Nicholson. Alright, so we'll run this. Alright, so some of the Greeks are missing, but that's by default through RQuantLib. We do get a value of 1573, and currently its value is approximately about $20. But we can try and price this as a European option. We'll just take away crank Nicholson. Run this, and now we get the Greeks, but our price is still off by approximately $4 or $5. It's probably something to do with the volatility, but we can calculate the implied volatility by running American option implied volatility. Then I'm going to copy all these parameters. And I'm going to add value. So the value of the option is 1990. So I'll save this as numeric. So we'll calculate implied volatility. So the implied volatility is actually 36%, which is almost in line with TD Ameritrade's calculation of approximately 42%. So now if we try to run the pricing model again, but instead I'll replace volatility with the implied volatility, we actually get closer to the value of the option in the market. Some of the factors affecting options are mostly the underlying price of the stock and its volatility, and we can create a vector where we pass in any two of these parameters as a vector. It'll return all the prices and the Greeks as well. So here I'll save a vector of prices for the underlying asset. So I'll write sequence from 350 to 450 by 5, and then the implied volatilities I'll save as sequence from 10% to 100% by 10%. So these will represent the stock prices between 350 and 450, and the volatilities between 10% to 100%. So we could use European option arrays. So here I'll copy these parameters, paste them here, and then for underlying I'll replace it with my vector of prices, and I'll do the same for the volatilities. So just run that. Now we get a nice list. Let me save the values by rounding everything to 2 decimal places. So here we see the possibilities of the underlying price versus the implied volatilities. And all these are possible option prices given the stock price and the volatility. So since Apple is currently around 390 and the implied volatility is around 36%, it's trading somewhere in between here. So between 30 and 40% and around 390. And here you see what would happen if stock rises or falls along with its possible volatilities. So you could take a look at the Greeks as well by running OP, and then we have delta, gamma, vega, theta, rho, and then the dividend rho as well. Alright guys, so that's a brief overview of pricing options with R. Let me know if you have any questions. Thanks for watching, and I'll see you guys in the next video.